Hello and welcome to Portfolio Matters, weekly markets checklist, week 169. And I'm back from my trip to Japan. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics on the show. Full disclaimer can be found at the end. So before we get going, a few housekeeping items. So for the next few weeks, I will be recording on a Tuesday with Stuart Owen, as Richard is away, and actually I have some weekend trips lined up, so I'll be away on Fridays. Medium term, so in about a month's time, I hope to get back to Friday schedules. Also, we've had a discussion on the Discord about how to improve the weekly podcast. In particular, it was just getting very long. So what we're going to do is we're going to be slightly more selective in which macroeconomic data series we present each week. It's become clear to me that a lot of things that I present are just noise and are adequately captured in, for example, the New York Fed's nowcast, things such as the regional Fed PMIs, etc. So we will be excluding those from now on. If I've done this right, you should not notice any difference. In addition, I will also only be covering every week the charts of commodities and equity market indices where something has happened. Now, this week, because we've been away for a couple of weeks, I'm actually going to go through most of them. But going forwards, if there's nothing happening, I won't be showing you the graph. I'll just be summarizing what's happened. Okay, going through the news first. Well, over the last couple of weeks, we've had a lot of inflation data. So UK inflation came in soft for July at 2.2%. That was below expectations, but is still bounced up from 2.0% in June. US inflation also came in slightly soft at 2.9%. We've had preliminary EU inflation for August that came in on target at 2.2%, well down from 2.6% in July. So everywhere we are having disinflation. In the UK, the Prime Minister, Keir Starmer, has given us advance warning that the October UK budget will be painful as the new Labour government aims to fill a £22 billion budget black hole. We're expecting rises in inheritance tax, VAT, and taxes on pensions. But having pledged not to raise income tax or national insurance tax, he did slightly roll back on that promise. So we'll just have to wait and see what happens next month. In the US, Kamala Harris has proposed to tax centimillionaires, that is, people with more than $100 million in assets, at least 25% per annum, for a mixture of income tax and a tax on unrealized capital gains. Now, I don't think that works very well. Let's see whether she gets that through. Elsewhere in the Red Sea, Houthi rebels have attacked an oil tanker with drones, setting it ablaze, and political turmoil in Libya has forced the closure of the major oil fields, and oil production is now down 700,000 barrels a day. Despite that, and we'll take you through the data, oil has had a bad few weeks, and geopolitical tension is not causing it to rise. Oil seems structurally weak at the moment. Elsewhere, equity markets, having plunged earlier in the month on the yen carry trade unwinding, as we covered in the last episode, have recovered almost entirely. We'll take you through the data, some charts relating to the news. Well, this is the S&P 500, having plunged 9.7% in late July. It's now almost back to all-time highs. And if you look at the equal weighted S&P, it is back to all-time highs. So what's happened is there's been sector rotation away from big tech and Nvidia towards the broader market. So the Russell 2000 has also done well. Markets are now expecting a full 1% of cuts by year end. We're expecting the Fed to start cutting rates this month. So despite the continued attacks in the Red Sea and the reduced transit through the Suez Canal, you can see that shipping rates appear to have peaked for now. And on to this week's economic data. So this is economic data for the last 3 weeks. So frankly, there is a lot of it. Quick summary, the UK appears resilient, but is not growing strongly. EU is weak with little signs of improvement. The US remains strong, although there are some signs the rate of growth is slowing. China looks weak. Stuart, the UK.
Okay, so first up, CPI, the month-on-month came in at -0.2 against expectations of a small rise of 0.1. So, yeah, disinflation in the UK, which converts year on year into a number of 2.2%. So, if you have a look at that chart, we're totally back in line with target and sort of average over, frankly, the past almost 20 years. Core CPI wasn't negative, though. That was up by 0.1% on the month, which means that on a year basis, it's now at 3.3%. So a little high, but not too bad. Oh, actually, hold on. When you represent it as a chart, there's a little tick up there, isn't there?
This is RPI.
Oh, RPI. Oh, sorry. Yeah. So RPI is 3.6% in July. So some difference in the composition there.
Yes, RPI, is being phased out at the end of this decade, because it tends to print high. So, it's not terribly surprising it is higher than CPI and core CPI.
Right. Energy prices. Well, there has been a bit of a rise in the price of gas, which feeds through pretty directly to the price of electricity. And I think the interesting point here is that although prices have been falling, they haven't fallen back to the pre-invasion of Ukraine levels. Right, now turning to obviously the most important component of inflation measure, that is restaurant and hotels, where we're seeing a fall of 0.4% month on month, which makes the year-on-year number only 5%. But I suppose good news for consumers, bad news if you're in that industry. Implicitly, demand is falling away there.
Yeah, and restaurants and hotels have been the biggest component of high CPI inflation over the past year. So that is really good news. Finally, it's coming down.
Looking across the world, here are some other CPI numbers year-on-year basis, and a real convergence at around 2.5%. I think the interesting one to me here was that the US leading the inflation initially and also leading the way out as well. But everyone's seemingly converging on about 2.5%. And okay, we've got decomposition of the UK CPI here, showing goods inflation, which had led the way on the way up, has also led the way on the way down, and it's really services which are proving somewhat sticky in terms of their rate of reduction of inflation.
Yeah, still at 5.2%. So that's still way too high.
Core CPI has fallen to its lowest level since September 21, and it's the same picture really of goods inflation having disappeared, even gone into deflation, whereas services still very sticky.
But the green line, which is core, that is quite a nice trend, actually, I'd say.
GDP quarter on quarter. Well, these are numbers which I think you've pointed out, Keith, are quite surprising. 0.7% in the first quarter and 0.6% in the second quarter. These are much stronger numbers than I was expecting. I really thought the UK had just sort of been flatlining, as the Tories sort of floundered around and there was no great direction from the centre, and yet the numbers this year have been perfectly respectable.
They have. But, Stuart, when I look at this chart, and maybe it's just me, but I think I see some seasonality. So if you look at 2022, the first two quarters was strong. Next to its latter half of the year, zero. 2023, poor year, but again, first two quarters, much stronger than the last two quarters. So let's see what happens in Q3 and Q4. But the UK has certainly outperformed all expectations. Reminder, the IMF had UK GDP growth at 0.6% for the entire year, and we've had 1.3% in the first half.
Representing that year on year gets to 0.9%. Month on month, well, I think these numbers are quite choppy, aren't they? It must be very difficult to create a monthly GDP series. Basically zero for June after 0.4% in May. So I think we need that to average itself out over time. And using that data series, GDP year over year is up by 0.7 in June.
Yeah, so the UK economy, that is not strong. It's been resilient, but you can't say it's thriving.
Business investment quarter on quarter was down 0.1% in Q2. I mean, that just strikes me as, yeah, why wouldn't it be? Why would you press ahead with projects until you see what Labour is going to propose and what they're actually going to come through with in terms of workers' rights, but also their support, for instance, of green transition. I think it doesn't surprise me at all that everyone's sat on their hands.
Yeah, I agree.
Business investment year over year, minus 1.1%. Do we know if that's nominal or real? Not very nice, is it?
That should be real, I would hope.
Okay. Construction orders year over year. Well, this is a totally astounding number, up 28% after, what's that, 6 quarters of reductions. So that's a fantastic number. It'd be interesting to know what was being constructed. I see today there's been confirmation of some energy contracts for green energy projects, which have been approved, but obviously that's not going to be in these numbers. But it's hopefully a sign of what's to come in terms of getting government policy on a more stable basis.
Yeah, I saw that, and obviously signing all these new wind farm contracts is good news. But at the same time, I read elsewhere that there's currently a 10-year backlog to get your wind farm attached to the grid.
Yeah.
So how does that work?
Yeah, it's a nightmare of permitting and getting pylons built, getting undersea cables attached. It's a real mess.
Yeah.
Retail sales month on month up by 0.5%, which was consensus expectations. And May's previous number of minus 1.2 was nudged up a bit to minus 0.9. But still basically sort of flat, up a bit, down a bit. Our retail sales year over year, therefore, was at 1.4%, so nothing special.
Yeah, not great.
Industrial output month over month, again, a pretty strong number, 0.8%, after May's 0.3%, so not bad.
Yeah, much better than expected.
Which unfortunately year over year is still minus 1.4%. Construction output year over year, minus 1.7%. A touch better than hoped for, but again, there's a large sort of pancake aspect to this of just flat, not going anywhere.
Yeah, but we've seen construction orders have risen quite strongly. So presumably in the coming year, we're going to see that start to rise. That's very good for GDP.
Yep. S&P's survey of global manufacturing, the PMI there was pretty strong. This looks a very encouraging chart. Up at 52.5 after having, a year ago being in the low 40s. So that's encouraging.
I find this really puzzling, actually, because US manufacturing is not doing well. European manufacturing is not doing well. So what is it that we make?
What do we make? We make drugs,
Bombs.
we make F1 Formula cars. What else do we make?
Bombs.
Bombs.
Yeah.
Oh, this is Rolls-Royce or
It's one of
no,
our biggest
yeah,
exports. It's the arms industry. So
right. Services PMI, again, a little better than expected, 53.3. So the composite, therefore, looking, pretty healthy, actually, 53.4.
pretty healthy.
Industrial trends, new orders, however, not that great.
Yeah.
Minus 22. So that doesn't quite align, does it?
No. Yeah. Again, contradictory data.
CBI distributive trends, yeah, also pretty ugly. They've stayed remorselessly negative for a couple of years now. Consumer credit, 1.22 billion in July, fractionally under expectations, and there was a revision down of June's borrowing estimate as well. Though in the scheme of things, well,
Yeah.
okay, not that great demand for credit, but not awful either.
Not bad, actually, I'd say.
Net mortgage lending, I thought this was an interesting chart because you've got a useful sort of longer term scale on this. There's been quite a lot of newspaper coverage of the big bounce in mortgage demand. Well, it's not really. I mean, it's not still under the sort of pre-COVID mortgage demand. And presumably it's people who've got no choice, whose mortgages have expired and have to roll over.
Well, I think what this is also, it's net lending. So I think the fact it's low, given that mortgage approvals actually have bounced quite well, means that a lot of existing mortgage holders are choosing to pay down their mortgages.
Ah, yes, that's a subtle point, but that's important. Yeah, it makes sense. Why pay? I mean, what's a mortgage rate now? 4.5% or something?
Yeah. When you're not going to get that on savings. So, rather than save money, you try and pay off your mortgage.
Yeah. Net lending to individuals, that is showing a bit of a bounce back, isn't it? After a week, it's 12 months. 4 billion was the actual number in July. Money supply. Now, this is interesting, isn't it? Because, it seems to me you could pretty much draw a line, the pre-COVID, extend it now to the post-COVID, and it's back on its previous trend after an acceleration in 2020 and then a paring back of that in 2023.
Very good point, Stuart.
Consumer confidence, not too bad, coming in at only minus 13. Given that it's been down in the minus 40s a year or so ago, not bad at all.
Well, also, the last time Britons felt good about themselves was back in 2016. So it's actually not a bad number in the context of, pre-COVID.
Yeah. Balance of trade. Oh, well, one always expects this number to be awful, and it was minus 5.3 billion in June. Expectations for some reason were at minus 1.1 billion, so a painful miss, but I think we all expect these numbers to be continually negative.
Yeah.
PSBR x the banks. Yes, there's a lot of issues, aren't there, with how banks and reserves affect the PSBR calculation. Actually not too bad in July, minus 3.1 billion. I say not bad, just looking at the chart, but actually expectations were for only minus 1.5 billion.
Yes. So, the Labour government needs to get the finances under control. And so, we're talking about tax rises and cuts in spending.
Yeah. UK BRC retail sales year over year, 0.8% in August. Right, we have a little bit of detail here. Food sales increased 2.9% over 3 months to August. Non-food sales fell 1.7%. So that's indicative of you spend on what you have to and avoid what you don't have to.
Yeah. So I was quite struck by the decline in big ticket items, furniture, durable goods, etc. So this is data out this morning, I believe, actually.
Right. So this is, you don't buy a sofa, but you might buy yourself a nice ready meal.
Yeah.
Nationwide house price month over month fell by 0.2% against expectations of a small increase. Year on year, price is up 2.4%. I must say, I think if nominal house prices could remain roughly flat or just go up a little bit, and gradually improve affordability as wages rise, that would be a good outcome. Obviously,
Yeah.
very, very rarely work out in such a smooth way.
Yeah. We have a section on US home affordability coming up.
In Richard's absence, we've reinstated the Citigroup Economic Surprise Index, which is positive, but less positive than it was. So there are numerous sort of degrees here, aren't there? Given this is a measure against expectations, which are themselves constantly moving. So
Yes.
I think we can say this is gently positive, can't we? Indeed, jobs postings, that took a bit of a step change down, didn't it? So that's not
did.
encouraging. Yes.
I thought this was really interesting, actually, because last time on the last podcast, do you remember the claimant count in the UK spiked hard in, I think it was July, the July number. And I thought that might just be noise because we've been there before where you've seen very big numbers and then they're revised down. But actually, that is quite a big drop.
It is, isn't it?
Job
That's not
postings.
encouraging, is it? That's
Yeah.
wage growth tickled off a bit, but it hasn't shown any material reduction down to the sort of levels that I think you would be happy with, Keith.
No, not good.
UK GDP, this is just the absolute number, and actually looking in nominal terms pretty healthy.
Yeah, actually, it is in US dollars. So, the fact that sterling has been, recovered a bit since, for example, Liz Truss tried to destroy it, flatters us slightly. But, that trend is surprising, given the rise in interest rates, how resilient the UK economy's been.
Yeah, I do wonder whether they're using perhaps a PPP exchange rate, though, because you would think that, like in the 80s and the 90s, you would have seen very big movements because the exchange rate went from 2 to 1, didn't it?
Yeah, that's true.
UK pre-tax national income share of the top 1%. Oh, it's taken a bit of a step change down.
Yeah.
So that the top 1% are only earning 10% of national income. Right.
And that's actually down. That's a 30% hit in the last few years.
Yes, that is a surprise. I was aware that the general perception of inequality was sort of wrong, that actually on a share of income basis, in the UK, the rich have been getting less and less.
Yeah.
Part because of the minimum wage, part because of taxation. But
Well,
that
this is actually pre-tax, Stuart. So post-tax is going to be even worse.
Good point. I mean, that's a very big change in 2021, isn't it?
Yeah.
Pre-tax national income share of top 1%, comparing the UK with the US. Right, and the US has gone the other way. That is bearing out the general belief in the rich getting richer.
Yeah.
So UK summary, inflation came in soft, but wage growth seems to be stickily high. Q2 GDP came in at a pretty good 0.6%. Keith suspects there's some seasonality we will see over the rest of the year. Retail sales data shows that durable goods sales are weak, but the PMIs for manufacturing and services were pretty encouraging, actually. Indeed, jobs postings was scarily falling over just the past month. So there are some pluses and minuses. I mean, overall, the UK doesn't seem too bad. Certainly not how I was thinking it would be this year.
Absolutely. It's been amazingly strong given the rise in interest rates. I mean, once again, something I got totally wrong. Right. And on to the EU. So we also had Eurozone inflation numbers, and these are the flash numbers for August. And they met expectations at 0.2% month on month, year on year. Great. Down to 2.2%. In August, a sharp fall from July, and rapidly approaching the ECB's 2% target. Core, though, remains high, came in on target at 2.8%, and that's only a small drop on July. Now, if you look at what is causing EU inflation, just like the UK, services inflation remains much higher than it was pre-pandemic. But overall, that just looks like a supply shock, a one-off, with inflation slowly returning to where it was pre-pandemic and pre-invasion of Ukraine. Turning to employment change in Q2, that met expectations, a rise of 0.2% quarter on quarter, year on year up 0.8%. GDP growth in Q2 was a resilient 0.3%, and that's the second quarter in a row where the Eurozone has reported actually okay by its own historic standards quarterly GDP growth. So year on year up 0.6%. Wage growth falling to 3.6% in Q2, and that was well below expectations and sharp fall from Q1, and that is great news for the Eurozone. So unlike the UK, Eurozone wages are coming back under control. Industrial production, however, in June continued to fall, down 0.1%, much worse than expectations, although better than May. And the May number was revised down. Year on year, worse than expectations, down 3.9%. And this morning, Volkswagen were talking about closing one of their German factories for the first time. And one of the reasons they were giving for consulting about doing that were that they'd negotiated with the unions insisted on large pay rises, and they've got increased competition, they can't afford it. So they're now talking about closing factories, cutting jobs. Construction output bounced back, up 1% year on year in June, much better than expectations and much better than May. The PMIs not very encouraging. August manufacturing PMI 45.6, worse than expectations, slightly down on July. No sign of recovery in Eurozone manufacturing, and puts the UK number in context. UK manufacturing doing much better. Services ticked up, and that's a good number and much higher than expectations. So that means the composite had a bit of a bounce. Balance of trade, Eurozone is back to being quite a strong exporter with a positive balance of trade, but the surprise index firmly negative, not doing so well. Looking at the jobs postings index, seems to have stabilized over the last month. Wage growth in Germany has bounced, though. In France, having fallen sharply around the election, the job postings appear to have recovered, but wage growth is collapsing. Reminder, France currently doesn't have a government. So EU summary, inflation came in on target in August, down to 2.2%, quite a sharp fall from 2.6% in July. That will please the ECB. GDP growth was 0.3% in Q2, so Eurozone is weak, but avoiding recession. Wage growth fell sharply to 3.6% year on year, Q2, that's good news. And manufacturing continues to be weak, services are strengthening. So overall, the EU economy is weak with actually little sign of strengthening, I would say. On to the US, Stuart.
So the CPI numbers month over month were 0.2% in July, but that did follow minus 0.1% in June. So looking at that year over year, we get to 2.9% in July, so close to the Fed's target, though that, of course, CPI isn't their exact measure. Core CPI month over month, 0.2% in July after 0.1% in June, so not too bad. which makes very nice year-over-year readings. June was 3.3, July down to 3.2, and quite a nice trend there. So over the past 3 months, there's actually been essentially no inflation in the US, according to Arch, which have produced these forecasts of what CPI would be depending on different assumptions. And they have inflation coming down to almost zero if the previous 3 months average of inflation continues for the next 9 months. And on different assumptions, they have different forecasts here. Core inflation is falling again after a brief blip up earlier in the year, which had us all worried.
Yep. So if you take the 3-month annualized, that's actually below target now. Great.
One of the reasons for this is that one of the big pushes to inflation, which has been auto insurance, has shown some signs that it's peaked out and is coming back down. I believe part of this is electric vehicles, which, if they do crash, are more expensive to repair.
Yes. Now, we've talked about this many times on the podcast, Stuart, and although it's peaked, it was still up 1.1% in July, and that was a big component of overall inflation.
Okay, there are so many different ways of cutting this data. The super core inflation measure, which is core, but then also excludes shelter, where obviously there's been big debates about how that should be measured. So super core rebounded in July, mainly due to that auto insurance, which contributed 0.13% of the 0.21% monthly number.
Yeah, and as we've talked about before, the rise in auto insurance prices is a secular trend. Rising interest rates have no effect on that whatsoever. So that means that interest rates are higher than they need to be, given that inflation is being caused by this secular trend, as you say, and when electric vehicles are more expensive to repair.
Right, now having a look at shelter, because it's such an important debate about how much inflation is being presentationally elevated because of the method of calculation. So here's very interesting. The blue line is the CPI owner's equivalent rent that goes into the official calculation, but the green line is the Cleveland Fed new tenant index, which does indeed seem to have both has led on the way up and also led on the way down, and suggesting that the averaging process in owner's equivalent rent will mean that the official statistic has to trend down over the next 6 to 12 months.
Yeah. A reminder, owner's equivalent rent, because people are on normally annual rent increases, that means that there's at least on average, a year's lag, basically, in the OER versus market rents.
Right, so this decomposes the CPI, US CPI, and falling used car prices were a big contributor to this recent drop in the CPI, because that obviously famously had been part of the big boost to CPI during COVID, but that seems to be well behind us. Right, now this is a slightly complicated chart, but it's the number of components of the CPI, or their weighting within the CPI, of those components whose inflation is above 2%. So in a sense, it's a diffusion measure. How broad is the inflation? Now that has been as high as 90% of the combined weight of the CPI has been increasing at more than 2% a year. Well, that's now down to mid-60s.
Yeah, and actually in line with pre-COVID.
One issue, of course, for US inflation is health insurance. Now, there's been, according to these statistics, a shocking, surprising, huge reduction in health insurance prices, which was news to me.
Yeah, I mean, look, the thing is, Stuart, this is puzzling, but if you were to look at it, as, let's say, excluding the COVID shock, then perhaps that's plausible. But the COVID shock wasn't really until, beginning of 2020.
Well, when did Obamacare really kick in? Would that have increased it? You would have thought it would have reduced it.
So this is puzzling and has flattered US inflation numbers over the past year. Does anyone actually believe this?
US PCE inflation, which is the measure the Fed really focuses on, month over month was up by 0.2%, which was bang in line with expectations. But that makes it year over year 2.5%, so getting pretty close to the Fed's 2% target, and they're supposed to be plus or minus 1% around that. So you could argue they're there. Core PCE was 0.2% in July, which was bang on expectations. No news really, which makes it year over year 2.6%. So the Fed is happy. US GDP quarter over quarter, the second estimate for Q2 is 3%. So this is quarter over quarter annualized, isn't it? The American way of presenting the data. So on this measure, no problem at all. 3%.
Yeah.
Thank you very much.
Looks great.
US corporate profits quarter on quarter, up 1.7%, annualized. Consumer spending, 2.9%. Nothing outrageous one way or the other. That looks encouraging. US ISM manufacturing PMI, however, well, you prefigured this, didn't you, Keith, saying, well, manufacturing in the UK apparently was doing well, but not in Europe and not in the States. The reading came in at 47.2.
Yeah, so not great. This is numbers out an hour or so ago.
US construction spending was down 0.3% month over month in July. So that broke a series of actually quite respectable numbers. Retail sales month over month up 1%, though the June number was revised down from 0 to minus 0.2%. But the year over year number, 2.7%. And again, these are all very nice, not extreme numbers one way or the other.
Yep, that looks perfectly decent, actually.
Industrial production month over month fell by 0.6%, and the June number was revised down from 0.6% to 0.3%. So not so encouraging. Year over year, that means that now industrial production is falling by 0.2%.
Yeah.
US durable goods orders month over month recovered from a very poor June. June was down 7%, July was up 10%. So perhaps some quirk in the data there.
Yeah, that's all aircraft, actually.
Ah, okay. Oh, right. So when you exclude transport, which presumably is aircraft, it's a much flatter picture. This is shipments of non-defense capital goods, excluding aircraft. Seen some quite protracted weakness over the past few years, falling from pretty respectable growth rates towards basically flat.
Yeah, and this is quite, there's a pronounced cyclicality to this, and it is steadily declining.
I wonder if the non-defense aspect, however, I mean, if you're using this as a predictor of recession, the defense spending will be increasing, don't we? So perhaps that will bail out this statistic.
Well, you have had it quite negative before with no recession.
True.
For example, in 2015. But, generally, it's a good indicator of economic weakness.
So real non-defense capital goods, excluding aircraft, orders versus shipments. So basically, well, both are weak, aren't they? Both are falling year over year.
Yeah, orders are weak.
The Conference Board leading index. Well, this is fascinating, isn't it? Because it had been previously a pretty good predictor of a recession.
Yeah.
This time it confidently predicted it. But it didn't happen, and I think we've covered this subject in great depth.
Yeah.
The housing market index. Yes, you mentioned this before, didn't you, Keith? This is very gloomy, coming in at 39 against expectations of 43. But I think generally the picture is just weak, as we would have expected. Building permits. Oh, that looks horrible, doesn't it?
It does. Yeah. So it seems to have taken a hell of a long time, but there are signs that the US housing market is finally weakening.
So this is housing starts, isn't it? Not used. This is not.
Yeah,
This
so
is
this is
new.
building permits, which are
Yeah.
down, and then actual housing starts in July. That's quite a big,
Yeah. So yeah, I mean the extraordinary thing was a year or so ago the house building stock's doing so well, wasn't it? Which seemed,
yeah,
but now volumes are clearly falling both in terms of permits and actual starts. Case-Shiller house prices are up another 0.6% in July. Expectations had been for about 1%, but the wonder is still that they're going up in aggregate.
yep,
So representing that as year-over-year data, yes, there was a small fall at the beginning of 2023, but since then the house prices have still been upwards. 6.5% year-over-year was the July measure. Michigan consumer sentiment, not that optimistic really, is it? It's a small bounce, but
yeah.
yeah.
But we've talked about this before. There's this structural issue that consumers just seem less confident post-COVID, and whether you can compare the current number with the pre-COVID trend.
Yes, right. Oh goodness, this measure of Michigan measure of current conditions is awful.
Yeah,
Fallen massively since the spring.
yeah. Now this is really interesting. So US consumers are not feeling good about the world right now.
Consumer expectations, however, haven't fallen
Yeah,
as poorly as the previous statistic. 1-year inflation expectations seem firmly anchored. The Fed will be pleased, coming in at 2.9%. The US Chicago National Activity Index, not too encouraging. July minus 0.34 against the expectations of flat.
yeah. But at the same time, Stuart, so the National Activity Index is measured in standard deviations. But bear in mind that in Q2, we had 3.0% annualized GDP growth,
Mm,
which I'd say is
it was
above
good. Yeah.
average. And,
So is this a candidate for noise?
I'm not sure.
Mm. The PMI for manufacturing in the US, that's not encouraging.
Yeah.
Came in at 48, so rather weak. Services, much like Europe, where manufacturing was weak and services was strong. Services was also strong in the US, 55.2. So the composite also recovered up at 54.1.
Yeah. Perfectly good number.
US Johnson Redbook retail sales up 5%. Again, perfectly respectable, slightly spiky statistic, but that
Yeah.
looks, given that it's a nominal number, that looks absolutely fine. Initial jobless claims, well, there was a real run-up, wasn't there, in April, May, but that seems to have plateaued, and
It does.
it came in at 231,000, but I think more importantly, there's no real sign of acceleration.
Absolutely.
The continuing jobless claims do seem to have reached more of a plateau, not so encouraging.
Yeah, but they're not accelerating, not trending upwards.
Right, so what have we got here? The continuing claims not seasonally adjusted versus the recent non-COVID average of that. So continuing claims, right, so this is your point that they've sort of peaked out and are not getting worse. So we've got a layoffs indicator here from two different sources, I believe. Right, this was the famous warn notices are being compared with an algorithm that goes through companies' 8K filings, trying to anticipate the degree of layoffs. So here we're seeing the algorithms picked up early signs in the 8Ks of some higher level of workers being laid off, higher than you'd expect from the warn notices.
That's right. Yeah.
Right, so a bit more detail on the 8Ks. There's more detail on the left here about what information is in an 8K, how often they're produced, which is basically when something important has happened to a company. And those 8Ks are publicly available on the SEC's EDGAR website. So what's now possible to do is to use large language models to screen through those 8Ks and to come up with aggregate measures of, for instance, layoffs, but presumably this could be done for other things. So the Fed researchers used I think, is that Meta's Llama 2?
Yeah.
That large language model to scrape through these things and come up with a useful measure. The US Dallas Fed, a weekly economic GDP estimate is now at 2.3%. The Atlanta one is at 2.5%. I mean, all these numbers are remarkably sort of straight down the middle, so very attractive, moderate numbers. But the New York Fed cast 2.5% as well. St. Louis, 2.1%. But these are all surprisingly consistent and anchoring around the same sort of number.
Yeah, and not showing the US economy slowing at all meaningfully.
The US Citigroup Economic Surprise Index minus 24, though, so perhaps, although times are good, people are expecting them to be even better. US Indeed jobs postings, well, that doesn't look totally encouraging, does it? That's continuing to sort of slip off a bit.
It has.
And wage, well, okay, it's up a little bit on the previous readings, but I think the big picture there is that the rate of wage growth has slowed markedly.
Absolutely.
US trueflation, for what it's worth, but that took a massive step down and now is at just 1.2%. It's not seasonally adjusted, but that is quite a chunky number. Reduction, I mean.
Yeah. So trueflation, which, reminder, uses lots of online prices, try and get a feel for what US inflation is. It's showing there's really no inflation.
Right. So revisions to non-farm payrolls. This is very important. This is the births deaths model. Is that the issue here, Keith?
Yeah.
I think we've highlighted before that they have to make a guesstimate of the births and deaths of businesses, which is basically an extrapolation of recent experience. And if you're going to extrapolate recent experience, you're going to be okay most of the time. You're going to get it wrong at turning points. And I think we've just seen a very big revision down in the number of payrolls that have actually been created. And I think we've sort of implicitly seen this with the month-and-month revisions, haven't we? And now this is a bigger tidy up. I mean, it's all part of their standard process. But if you believe that the direction of revisions is an indication of where the economy is going, then this actually isn't very encouraging.
Absolutely. I mean, you'll notice the last time it was this big was back in 2009. But I should also say that the existing non-farm payrolls numbers will continue to be published unrevised until the full calculation on the revisions is done next February. So we've talked about previously how there's this big gap has developed between the establishment survey, i.e. non-farm payrolls, and the household survey. The household survey being much less positive on the jobs market in the US, and it very much looks like the household survey is correct.
Oh, now this is a scary chart. I mean, this is a sort of tsunami which we know is coming, but we don't know when it's going to hit shore. And it's basically the US federal budget deficit. The huge gap between spending and taxation. And when you look, what could you squeeze on the spending side? Are you really going to squeeze Medicare? Are you really going to squeeze Social Security, defense? It's an awful situation. And the gap is 28% of spending is not covered by any form of taxation.
Yeah, shocking. But if the Democrats get in, they will start to do something about it.
Very complicated, though, isn't it? Because you need to have Congress on your side as well. Right, so US summary. CPI inflation came in slightly soft in July at 2.9%. Core was 3.2%. Inflationary pressures do seem to be fading. The Fed is happy. Q2 GDP was revised up from 2.8 to 3%. And all the various nowcasts show the economy growing very nicely, neither too hot nor too cold. Retail sales bounced back in July. Durable goods orders, however, do seem to be fading. And the August manufacturing PMI did give some cause for concern, though services remain strong. So looking across the world, the US really is the center of where growth can be found.
Thank you, Stuart. On to China. And we had the NBS PMIs, manufacturing weakened further to 49.1, not a good number, down on July, well below expectations. Services, 50.3, well below historic norms. So average for previous decades, and that's just not strong. Better than expectations though. So overall, the general PMI came in at 50.1, which indicates just an expansion, but much worse than the historic average. Chinese economy not doing well. House prices year on year were down 4.9%, better than expectations, but worse than June. House prices falling. Chinese industrial production came in better than June, but lower than expectations at 5.1%. Retail sales, 2.7%, actually better than expectations. Fixed asset investment weakening further, and that is a poor number compared to history. You'll see how investment is fading. Unemployment rate ticked up. Foreign investment in China has absolutely collapsed, down 30% year on year. So this is Chinese consumer confidence, and it is close to an all-time low, and it has really taken a battering in the last few years, post-COVID. And I thought this was really interesting. This is the Chinese money supply, and you see it does appear to be correlated with GDP growth, and that's a bad sign because it's gone deeply negative. Now, one of the reasons that M1, the money supply, is declining is that loan growth, mortgage loan growth, is negative. So the stock of mortgages is actually shrinking. More loans are being paid off than taken out. And this is from the FT. This is office rents in various Chinese cities, and you'll see they've been falling over the last few years. The FT is reporting that in Shanghai, 21% of offices are vacant. So overall, it doesn't look like the Chinese economy is doing very well. And as you'd expect, when a property bubble bursts, the effects can last for many years until that excess stock of housing is cleared. But people will have borrowed a lot of money to buy houses which are then worth less than the loans, and that causes structurally low consumption, consumer spending. So I'm expecting actually the Chinese economy to be quite weak going forwards for potentially years. Stuart, any thoughts?
I totally agree. I mean, there's the aging as well, which will encourage saving. There's the lack of a sort of social safety net, which encourages saving. If I was a Chinese consumer, I'd be battening down the hatches.
Yeah. And onto one chart. Now, this is income tax data. So it's the year-on-year change in income taxes in the US, the volume. And that is an indicator of wage growth and employment growth. And it has been falling, and so the rate at which income taxes have been rising has been fading, and that is highly correlated with the red line, which is the unemployment rate, and that's on an inverted scale. So declining growth in income taxes is correlated with rising unemployment.
I'd like if HMRC produced exactly that data, because their number of employees survey is one that we regularly give a kicking to, whereas
yes,
that data looks rather useful, doesn't it?
It does. And you see here that, the income tax growth is fading and unemployment rate rising. So unless that turns round, it would indicate that the unemployment rate is going to keep on rising.
Okay, so how low would US interest rates need to go to fix the US housing market? Right, so here is the 30-year mortgage rate, the standard rate a borrower would have to pay, which got down to amazingly low levels of about 2.7% and then spiked all the way up to just under 8%. It's come back down to 6.5% now.
But that's still a hell of a lot higher than it was in the decade pre-COVID.
Yeah. So despite the cost of a mortgage having gone up, house prices have continued to rise, which we've highlighted a few times on the program.
Yeah.
So you've got higher mortgage costs, which were going to be applied to a higher nominal price of a house. Therefore, affordability is going to be hit both ways, as it were. You've got to borrow more and pay more on the borrowing. So the affordability index has fallen from over 200 to under 100.
Yeah, it mystifies me that house prices are going up. How does that work?
Yeah. So existing home sales have double dipped lower as more buyers sit on the sidelines. Well, this is, I think, what you would expect, isn't it? That if you have a house which you've mentally marked to a certain level and you're not going to accept a low offer.
Yeah.
So I think we've seen this so many times, isn't it? It's not price that adjusts, it's volume. People sit on their hands. The inventory of stocks, not of stocks, sorry, inventory of housing shows this effect. So existing houses, the inventory has been going up. It's still not actually at a very high level. It's nothing like during the GFC. So that's of existing houses. People have been sat on their hands. The amazing thing to me is that the inventory of new houses has been going up so quickly. I can totally understand that at the beginning of a correction, a house builder will continue to build out the houses they've got at their stock. But the fact that they've continued to do it and haven't sold enough to prevent the stock increasing just bamboozles me.
Yeah, absolutely. I'm mystified by that because we know they've been carrying on building. We reported this, month on month in the last 18 months, but it seems that they're not selling that many.
And yet they continue to build. It's not just in the initial phase of the shakeout. So affordability for first-time buyers. So if you wanted to be able to pay the normal amount in your mortgage, what mortgage rate would you need to apply to the average house price so that you were paying the normal amount of your salary as the mortgage?
Actually, sorry, Stuart, it's not quite that. It's like, so at 100, it means the median family would meet the minimum to qualify for a mortgage on the medium priced house.
Got it. Right. Yeah. But to get to that measure of affordability, the interest rate they'd be paying on their mortgage would not be the over 6% that we saw as the national average in a couple of slides ago. It would have to fall all the way to 3.4%. And that strikes me as very, very unlikely. Given that 30-year fixed rate mortgages, as we've just been discussing, are over 7%, it's getting back to 3.4% would be the levels that prevailed when interest rates were at zero. This means that in order to incentivize existing homeowners to sell, mortgage rates would need to fall to about 3.5%. Now that's the sort of level they were during COVID, when many homeowners refinanced and locked in their mortgages. So this strikes me as a very unlikely level to get to. I mean, it's a big debate about what's going to happen to inflation and interest rates in the next few years. But to get back to those extreme conditions strikes me as pretty unlikely. 30-year fixed mortgages against the 10-year Treasury yield. Well, obviously there needs to be a gap. A 30-year fixed mortgage has to yield more, not least because of the optionality of the homeowner refinancing. Now, the gap between a 10-year Treasury, which is now trading at around 4%, and the 30-year mortgage, which is around 7%, the gap is about 3%, which is probably wider than just eyeballing this chart than it normally is.
Yeah.
But that would sort of imply that if the 30-year mortgage needs to get down to 3.5%, then the Treasury would need to be under 2%, and more like even 1.5%.
Yeah.
To me, this just reinforces again and again just how high the nominal house prices in the US are, and therefore the risk of stagnation at best to crash at worst. So in summary, asset prices are inflexible on the downside. I think we all feel this about our own properties. You tend to mark it up in your mind and don't want to mark it back down. Housing isn't really an efficient liquid market because houses aren't perishable goods. You can choose not to sell if you don't like the price. So in a down market, volumes fall rather than prices. The US housing market is suffering from very low affordability. That could be solved in three ways. It could be solved via earnings growing, or house prices falling, or interest rates falling.
Yeah. And it looks to me like, house price affordability is just so bad that lots of young people are basically locked out of the housing market. Something's got to give. And, I don't know what it's going to be. It's not going to be strong real earnings growth because you just require so many years of positive real earnings growth that it's just implausible. So either interest rates have to fall or house prices have to fall. And, they're just not falling. So it seems like fundamentally unfair to young people.
This is a completely sideboard point, but perhaps this is why people punt around in crypto, because there's no way of taking part in the regular financial market of housing. So people sort of buy a lottery ticket, which is a crypto token.
Yeah. And on to the difference between gross national income and GDP. Now, we talked earlier about how US GDP for Q2 was revised up to an annualized 3%, implying that the US economy was doing just fine. But GNI is less optimistic. Now, what is the difference between GNI and GDP? Well, in theory, they're both measuring the same thing, which is the amount of economic activity in the economy. GDP looks at total expenditure, but every pound spent in the economy is also somebody else's income. And GNI looks at total income in the economy. The two should produce the same results, but they don't. And you'll see the blue line here is gross national income. The red line is GDP, and the two have diverged over the last 18 months, with GDP rising much more than GNI. And I have downloaded the data from the St. Louis Fed, and these are the quarterly changes in GNI and GDP. Now, I should caveat this by saying the numbers available on the St. Louis Fed website were seasonally adjusted annualized numbers. So these are the quarterly changes in those numbers. And so therefore, they differ from the numbers we report, which are not seasonally adjusted, I believe. But you'll see that over the last 18 months, the cumulative change in GNI comes to 6.2%, GDP 8.5%. So GNI, the income measure of economic activity, is much less optimistic about the US economy than is the GDP measure. Okay, now a Fed paper back in 2010 analyzed this, and it found that GNI is the superior measure. So GNI is more cyclical than GDP. GNI grows more quickly than GDP when the economy is robust and more slowly when it's weak or in recession. And the statistical discrepancy between GDP and GNI is negatively correlated with the business cycle, i.e., when there's a big discrepancy between the two, the economy is weak. And that is where we are now. GNI, because it's more volatile, identifies the onset of downturns more quickly than just GDP, and GNI growth is more correlated to real-world economic indicators than is GDP, which again suggests that GNI is a better measure of economic activity. Now, why is that the case? Now, bear in mind, this paper was published 14 years ago. So the causes may have changed and the validity of this paper may also have changed. So it may not be as true as it once was, but the manufacturing components of GDP is computed with the aid of surveys, which at least in 2010 did not exist for the much larger services sector. So the Bureau of Economic Analysis has to impute the data for the service sector, which it has for the manufacturing sector, using indirect methods, so using trade service administrative and regulatory data. And that causes GDP to miss part of the business cycle. Note, the first estimate of GNI comes out about 1 month after the end of the quarter. So we've had that, but it excludes corporate profits or net foreign income. And that second estimate is only published around 2 months after the end of the quarter. And those revisions to GNI tend to be more meaningful than the revisions to GDP, which implies the revisions for GNI contain meaningful data. So right now, GNI is diverging from GDP, and GNI is once again lower than GDP, which suggests that the US economy is less robust than the GDP numbers are saying, and GNI is a better guide. So although the GDP numbers we report show the US economy growing strongly, GNI would have it that it's not as strong as all that, but not in a recession yet.
So Keith, if part of the logic of why the GDP stats are less reliable than GNI is because the services sector is less well covered, surely that problem's got worse since 2010. So given that the services sector has become a bigger and bigger part of the economy, so that does rather suggest we should switch our allegiance and start reporting GNI numbers.
Yeah, but the thing is, what moves markets is GDP. And the other thing is, Stuart, that surveys for the services sector didn't exist for a lot of this period, but apparently, there are more surveys now. So yes, the services sector is bigger, but perhaps it's better covered in the survey data. So we're not sure, but bottom line is they are diverging quite strongly at the moment. And onto the SAHM rule, Stuart.
Right. So the SAHM rule is a predictor of recession, but it was developed, I think, as with the intention of being an automatic trigger for fiscal support of unemployed people. It was her idea was, let's take a discretionary top up to unemployment payment out of the hands of politicians and make it into a technical rule. So she wanted to find an indicator which reliably indicated ahead of time whether a recession was just around the corner, and therefore whether the government social security payments should kick in. The point being, if you kick those payments in early, you could nip more of the adverse effects of the recession in the bud. and also get it out of the hands of politicians. So her measure, I think, is the 3-month unemployment rate compared with the lowest level it's been over the past 12 months. And if that reaches 0.5%, i.e. unemployment has begun to rise off its recent lows, then a recession is flagged as being just around the corner. And that's what's just happened now.
Yes.
So I think she herself has said that it might not be true this time round, because the 40% of the rise in unemployment has been caused by new entrants to the job market. And without that effect, the SAHM rule would not have been triggered. So this is not people, this is a sort of numerator denominator issue. It's not like people are being sacked, it's people joining the jobs market, which arguably is a good thing. Either they're previously discouraged people coming back into the employment market, or, and I think this is the current debate, this is fresh immigrants who are now qualify.
Yeah. But you notice that back in 1991, 34% of the change in unemployment was due to new entrants, compared to 40% now. It's not unprecedented.
Yeah.
It's not that different. What is different, she's saying, is the trend. I mean, so in the lead up to recessions, you get this drop in new entrants and re-entrants, i.e. people are discouraged from coming back into the labour force, and that's just not happening at the moment.
So there is a reasonably big difference, isn't there, in the job losers proportion?
Yes.
And if you think a recession is almost caused like by a sort of nominal overall aggregate demand slipping off, then that is less of a worrying sign.
Yeah, I agree.
So in the US, the SAHM rule has always indicated a recession, but that isn't true apparently in other countries. It was designed just for the US, and it's not fitted for data outside. So looking, for instance, at Canada, there was a very high rate of false alarm there.
Yes.
Yeah.
And, in other countries, Japan, you've had recessions without that rise in unemployment that would have triggered the SAHM.
In the US, the Mishéat-Saiz recession indicator aims to be a bit more reliable than the SAHM rule. It takes the smaller of the rise in the unemployment rate or the fall in the vacancy rate over the past 12 months. So it is signaling an increased danger of recession, but it hasn't reached the threshold yet. And even that is questionable, since the vacancy rate has fallen, but only back towards normal levels from very high ones. Right, this is not looking at so much at people being made unemployed as it is at vacancy rates.
Yes, so job openings. So we've again seen that job openings have been falling, and the unemployment rate is rising. And if you take the minimum of those two, then there's a heightened risk of recession. But unlike, it hasn't triggered like the SAHM rule's triggered.
So in conclusion, the SAHM rule has triggered, but it assumes the deterioration in the labour market will continue to get worse. And that is not clear that that's the case. And the Fed has got room to cut rates to support the economy.
Yeah. And finally, on to the outlook for the oil market from the EIA. And the EIA are forecasting that the most recent round of OPEC oil production cuts will support the oil market in the short term. So if you look at the bottom bar chart, you're seeing they are saying that in the second half of this year, and we're now moving towards the final quarter, that the oil market will be in deficit, which supports oil prices. But when OPEC start to open the taps next year, then the market will move into surplus and oil prices will fade again. And the fundamental problem for oil bulls is that OPEC are going from taking barrels out of the market to adding barrels in 2025. And so oil production is expected to grow by 2.1 million barrels a day in 2025, whereas demand is expected to increase by only 1.6 million barrels. So the market will move into surplus. And I thought this was interesting. So within the short-term energy outlook, this is the EIA's forecast for non-farm payrolls. And you'll see they're expecting US economy to slow in 2025. Now, that means if the US economy continues to outperform, then demand growth could surprise on the upside. They're showing that they expect US gas prices to recover from this year's lows, as the low prices this year have caused production growth to plateau. And this is shale oil production forecast, and they're forecasting that US oil production will grow by 460,000 barrels a day in 2025. And actually, most of the shale oil plays production is expected to increase. Natural gas production, you'll see that this year it's fallen as low gas prices have disincentivized drilling, but it's expected to return to growth next year. So bottom line is the oil market looks well supplied. Oil prices are only going to rise if demand outperforms expectations. No sign of a bull market in oil, and we'll take you through the data in due course, but oil has had a bad few weeks. Good for inflation. On to inflation watch, Stuart.
Right. So UK, 2.2% CPI inflation, core 3.3. Next meeting of the Bank of England coming up fairly soon, 19th September. US 2.9% CPI, 3.2% core CPI, and FOMC meeting 17th, 18th September. A cut is firmly expected by the markets. EU CPI 2.2, core CPI 2.8%, and their next meeting also very soon, 12th September. And Japan CPI 2.8%, core 2.7%. So coming into the range of the rest of the world.
Yes.
There are, of course, many different ways that one can cut the inflation data. And one nice way is the trimmed mean inflation target, where you take out the excess numbers on the upside and the downside and take the mean of the rest. Now, on that basis, the 12-month trimmed mean is at just under 3%. But if you take a shorter term measure, the 1 month trimmed mean, and annualize that, then we're below 2%.
Yeah, we're below 2%.
And Goldman are forecasting that shelter inflation will bounce back a bit in July. And we've covered this so often, the importance of the shelter component into the CPI measure. So on their base, their analysis suggests that there'll be a bounce which then trickles away. Having said that, that does seem to contradict those surveys that we had of rents being renegotiated at lower and lower levels.
Yeah, I agree.
Right, well, talking of rental inflation, here we go. This is another measure. This is data from Apartment List, and that's through to the end of July 24, and showing that monthly rents year on year are falling slightly. So in summary, US inflation does look to be under control. UK inflation is also falling, but core inflation remains a bit too high. And the fear there, particularly for the UK, is that wage inflation has not really come down to the levels consistent with 2% inflation.
Yeah. Thanks, Stuart. On to recession watch. So I thought this is interesting. We talk a lot about the SAHM rule and how the unemployment rate is rising, but actually high levels of unemployment occur generally after the recession has started. the current low print, 4.3% in the US, is not actually that unusual. You've had recession starting at much lower unemployment rates in the past. And this is really interesting. So the University of Michigan survey for August, people are saying that jobs are increasingly difficult to get. And that is well correlated with the unemployment rate. So people on the streets are finding it harder to find jobs. And the rise in the unemployment rate over the past year, frankly, is unprecedented outside a recession. If history is a guide, the US should already be in a recession. The rise in the unemployment rate is very consistent with a recession. And we've had a load of consumer companies reporting in the US, and most of them are weak. And Dollar General, now Dollar General sells basic items for $1 in the US. So they're very much, their customer base is very much the poorer members of US society. And their shares fell very sharply after reporting poor Q2 numbers and warning that lower income US consumers are running out of money at the end of the month. And the savings rate in the US is very low. So that's consistent with US consumers being cash strapped and unable to save. And the number of Americans working multiple jobs is at an all-time high. Again, it seems that poor US consumers are not doing well. And we've talked about this previously, that the Biden economic policy, which is massive deficits, high interest rates, is bad for debtors, who are the poor, and good for creditors, who are the rich. So Democratic president, his economic policy, not great, actually, for the poor. Bottom line, there's little sign of an imminent recession, but the labour market actually doesn't look great. And if the labour market continues to weaken, we could yet still have a recession, although, of course, the Fed does have plenty of room to cut rates to support the economy. On soft landing watch, Stuart.
Americans are still, however, still eating out, which you would think of as perhaps one of the first things that you would cut back on if times are tough. Obviously, there's a sort of compositional issue, isn't there? You might eat out, but not at the nice restaurant you previously did. You may sort of trade down.
Yeah, or you could eat out but spend less.
Yes. Restaurant Performance Index also showing a similar weakness after the sort of revenge spending, isn't it?
Yes.
After COVID, but that's ebbed all the way back.
Yeah. So actually, this is interesting. It shows that although Americans are going out, they're not spending as much, according to the restaurants are not doing well.
They're probably having to spend it all on the tips, the 30% tip. US credit impulse has bottomed. It remains a mild drag on the economy, but could soon turn supportive. And this is an issue that you've raised many times, Keith, that it's not levels, it's rates of change in previous. Oh goodness, I'm screwing that up.
Yeah,
but
it's the rate of change in credit. So, if credit growth stabilizes, then it's zero. So it's kind of the acceleration or deceleration in credit growth. So when credit growth stops falling, you get to zero. Credit growth rising again turns positive.
So bottom line, the US economy is doing just fine for now. Analysts expect that will continue, but there are some signs under the surface that, in particular, the employment situation isn't quite as rosy as it seems.
And onto other charts. So when you adjust US house prices for inflation, they are way above their historic average over the past 130 years. So going back to our conversation earlier, house prices, they just seem totally unsustainable. And this is e-commerce sales as a percentage of total retail sales. Over the last 25 years, they've gone from pretty much nothing to 16%. That's bad for high street retailers. They're bad for rentiers who own high street shops or malls. And this is the outlook for energy demand. And in order to get net zero emissions, total energy demand would have to fall by 20% over the next 30 years. The vast majority of forecasters have it continuing to rise, and that's very bad for the planet, potentially, because there's no way to achieve this without still using hydrocarbons. And after that, some good news. And this is the ozone layer and depletions of chemicals that will affect the ozone layer. And you'll see that since 1990, they've absolutely collapsed. So when we put our mind to it as a species, we absolutely can fix pollution. On to equities, Stuart.
So turning to equities, as we highlighted right at the top of the show, there's been a really strong bounce back, such that the early August shakeout has been pretty clearly reversed. So you see that, for instance, in the Russell 2000, which is up 7.6% since we last spoke. Some markets not taking part, the UK up only 1% since we last reported the data. Bitcoin has been extraordinarily quiet, down just 0.3%. Some movements in currencies, though. I've noticed that the dollar being a bit weaker. The pound has risen 2.3%, is now at 131.
Yeah. Good. Sterling's doing quite well.
So the all-world index, we can see that recovery from the early August scare, which has totally surprised me that this has bounced back so strongly. I really thought we were going to get a cascade as risk models required positions to be trimmed all over the place, but it didn't work out like that.
Yeah, but at the same time, when you look at any market top, you do tend to get this double header. And it's not clear to me that we're going to carry on going off to the races. We'll show you the valuation charts in a sec. And, equities just look expensive.
The all share is up 7.4% for the year, but it's been sort of becalmed really since the spring. The Euro Stoxx 600 has been a bit stronger recently, up 5% since we last covered it, and up 9% for the year.
Yeah, I'm mystified by the performance of the Euro Stoxx because, we know the Eurozone economy is not doing well.
The S&P 500, I mean, this chart constantly surprises me, just how it returns to its upward trend, cover valuation, and it scared me, but I've been scared for years, and it's continued to do so strongly, up 18% year to date now.
Yeah, you and me both.
NASDAQ also up 18%, perhaps showing a little less exuberance. Some of the air seems to have gone out of a few of the stocks. It hasn't quite recovered the early August highs. Russell 2000, that, however, is where the money has flowed to, and that is up 7.6% since we last covered it. China, well, in particular, Hong Kong, at least, it's a much gloomier picture. Some attempted rallies this year, but basically it's an unloved market no one wants to touch, up 3.5% for the year. Topics, that is quite a dramatic chart, isn't it?
It is.
This was the epicenter of, well, not quite the epicenter, but it was next to the epicenter after the yen carry trade was unwound all over the place. Topics collapsed, was it 12% on the day? But it's bounced most of the way back and is up still 16% for the year.
Yeah.
Bitcoin, nothing much happening. Not often you say that. The currencies, as we mentioned previously, the pound has been reasonably strong against the dollar. Perhaps some interest rate differential expectations are going on there. The Fed likely to cut, less sure in the UK.
Yes, I think that's right. And but that, of course, is actually quite good for inflation.
Euro against the dollar, slightly similar, but not totally identical picture. Up 1.1% since we last covered it. The dollar index, well, there we can see that weakness. Since the beginning of July, it's fallen 5 or 6% on a trade-weighted basis. VIX, well, that is a wonderful spike, and that is just the close of day picture where the VIX was closed around 38. Intraday, I think it was peaked out at about 65 in the early August shakeout, but it's come right back down. Well, actually not all the way down, but it's down at 16 after having traded just a little bit above 10 for quite a while. So the S&P 500 having done so well, despite interest rates having increased so much. I mean, that was the expectation, wasn't it? Finally, if there was competition for equities from riskless cash, surely equities would fall, but it didn't play out like that.
Yeah, no, absolutely. I'm mystified. It's up 29% since the Fed started cutting interest. So it's up 29% since the Fed started raising rates. Mystified. Amazing.
Yeah. Well, this was a very interesting chart comparing the performance of capital intensive versus non-capital intensive companies. And this is world equities, not just the US, but basically, I suppose the return on capital for a business that doesn't employ much capital is typically so much higher, but that seems to be not represented efficiently in share prices because the non-capital intensive stocks have wildly beaten the capital intensive ones.
Yeah, absolutely. I think this is a really interesting and important chart, actually.
It seems pretty consistent, doesn't it?
Yeah.
Household allocations to stocks are near record highs, which has historically been the time to get out of them. Now, we've mentioned this a few times before, but it always strikes me as slightly chicken and egg. I mean, if shares fall, then the value of those shares in people's portfolios will become less and therefore a smaller part of people's overall assets. So this to me is not necessarily people chasing stocks. Some of this is the movement of stocks themselves. Everyone loves a bull market. Well, not you and me, Keith.
Well, that's right. Yeah.
Right. This is stock ownership, percentage of US households and non-profits owning stock. Is that right?
Yes.
Which, in the early 80s was down to about 9% after over a decade of dismal returns. Now it's over 40%. Everyone wants to own stocks after they've gone up. Right. I have to pronounce this one carefully. The euphoriometer. So this, I don't know, how do they measure it? It's just a deviation from trend, is it perhaps?
I'm not sure, actually. I'm not sure. It's a combination of forward PE ratios, very low volatility and sentiment.
Right, and it can't be more positive. Well, I mean, I agree with that, mainly based on valuation and momentum and difference from trend. But it's been wrong for a few years now. Valuations, we've covered this many times. I think this is the single most important measure of US equity valuations. This is the S&P cyclically adjusted price to earnings ratio, which is about 36. And that is just so much higher than before, for instance, the Wall Street crash of 1929. Lots of interesting arguments about why it should be higher with lower interest rates, etc., etc. But I think it's difficult to rationalize away a number so different from history. Yeah.
But when you say relative to lower interest rates, Stuart, over the past 2 years, they've risen quite strongly, but CAPE has risen. I mean, that completely goes against everything I thought I knew.
Well, I'm with you. Yeah. This is the Buffett indicator, which looks at US stock market value to GDP. I'm not sure as an indicator it's so relevant because so much of the US corporate profits come from outside of the US these days, mean, it might have been important in the 60s and the 70s, but now US stock market values are partly driven by international profits. So comparing to local GDP, I think it might be a tired old indicator. I like the fact that it's saying the same thing as CAPE, but underlying as a measure, I'm more doubtful of it.
Yeah, and I agree with you.
Stocks optimism meets bonds pessimism. Well, this is the big divergence, isn't it? That equities are certain of a soft landing. They are, and how is that being judged? And I think I can judge it just from the CAPE ratio, etc. But around this, it's being based off S&P behavior around previous hard and soft landings. Bonds are much more circumspect. I mean, I would come at this just a different way, looking at the valuation of equities via something like the CAPE ratio versus something like the valuation of bonds compared to inflation, which seems much more prudent and reasonable. Hedge funds have actually been sellers of equities in August. I presume this is the yen carry trade leading to an unwind of other positions.
Yeah, interesting though.
Market concentration, yes. Well, we've seen numerous studies illustrating just how concentrated the S&P 500 is, looking at number of stocks. But this is looking at the combination of tech, telecom, and healthcare, which peaked at 45% of global equities in July 24. And that's a similar sort of level of concentration as happened at the end of the dot-com bubble in the late 90s. So it's a sort of measure of exuberance and crowding into the same story.
Yeah, and that generally is not a good sign for the health of the market, this level of concentration.
September is often a tricky month. Was it September or October that's normally the most volatile? What have we got here? Well, no, this does suggest it's very much September, doesn't it?
It does, yeah.
Average annualized price return by month. Oh, annualized price return.
It is, yeah, annualized. So, but the only month with negative return on average is September.
Volatility of daily returns by month, again, September and October are the prime candidates, well, particularly October in terms of volatility. So difficult to know what to make of these numbers, but for what it's worth, October tends to be more volatile. Corporate buybacks appear to be one of the engines that have propelled the market higher, but cash as a percent of total assets has been falling. And I think we can see prime examples of this amongst the tech stocks, which are fabulously cash generative, but recently, of course, are having to use a lot of that cash, not for share buybacks, but for buying chips from NVIDIA, etc., plus data centers, etc. So it looks like they may be becoming a bit more capital intensive. We spoke previously about the performance or the unemployment rate and recessions and how unemployment rate increases during, not before, the recession. Well, similarly, if you look at the performance of the market before and after the first rate cut in conditions of recession or no recession, when there's a recession, the first rate Fed cut, that's the signal for the market to underperform. But if the recession is avoided, surprise, surprise, the market keeps going up. This slide covers Hindenburg Research's review of Supermicro. That is NVIDIA's third largest customer, and they've been accused of numerous different versions of fraud. Now, I think this is interesting because you often get these sort of specific micro stories at turning points, at inflections. Now, I don't know the full detail of it, but there does seem to be a lot of self-dealing involved in the manipulation of turnover.
Yeah, and so they've delayed filing their results.
Right, hence the stock has cratered and still above its 2023 level, but my goodness, it's up 2,200% over 5 years.
Yeah.
Even now.
Yeah, it's always amazing me how long it takes these things to come down. You know, when there's blatant fraud often the share price, doesn't come back down until literally, remember Enron?
Yes. Yeah.
Yeah.
And WorldCom, and what was the German one that
Yeah.
had to be put
Yes,
into
that's right.
people's faces? Yeah. Nvidia, they had their results recently, continuing to show absolutely astonishing growth. This is their revenue by segment, mostly seemingly coming from data center demand, which presumably is where all the chips get placed.
Yeah.
Revenue rose, what's that number? 120%. However, now my understanding is that Nvidia's results did meet the official expectation numbers,
Yes.
but the share price fell, so the unofficial expected numbers
Yeah.
were even higher. People were expecting to be positively surprised, and they weren't positively surprised as much as they were expecting to be surprised.
Yes. Exactly right, Stuart.
Yes. So Nvidia has fallen a bit. Meanwhile, Colgate shares have gone absolutely ballistic. My goodness, flat for about 3 years, and they've just gone to the moon from 70 to
Yeah.
110 for a company as steady Eddie, you would think, as Colgate. So what's the news there?
Well, I asked Google, and it's, this information box came up. I think it seems that they've raised their organic sales guidance to 6 to 8%, up from 5 to 7%. But that seems like one hell of a big move on a slight increase in sales guidance.
So this money's got to be somewhere, sort of argument, is it?
Yeah, I don't know. But, it seems the market is just generally exuberant, if you ask me.
Right. Husband Strategic Advisors. Now, they have been a very valuation-based investment manager, and they reckon US equity prices would have to fall 70% to reach a valuation consistent with 10% per annum future returns.
Yeah.
So this is presumably some mean reversion on their valuation indicators, is it?
Yeah. Yeah. So, I mean, obviously, equities can keep on going up and getting more and more overvalued, which is exactly what's happened over the last year. But compared to history, they're very strongly valued. And energy commodities. So generally, a few weeks. So in particular, oil went down 7%. And given all the disruptions in the world, the continued tensions in the Middle East and Libya cutting production due to political turmoil, that is, a sign that the oil market is structurally weak. Gas market, in fact, all energy markets, the same. So this is Brent. That's not looking good, actually, especially since Libya came offline.
And that's priced in $1 when the dollar has itself been depreciating.
Yeah, absolutely. Good point, Stuart. And this is WTI. Numbers specific to the oil market. And that is despite actual inventory drawdowns in the US. So the US has been undersupplied over the last few weeks, but the oil price has been cratering. And US oil production down from its recent highs, Baker Hughes rig count dropping. Going quickly through the charts, this is natural gas. And thank you to Stuart for sending this. This is US LNG capacity. So we are about here. So over the next 2 years, you're going to see a lot of new LNG capacity coming online. And that is potentially good for European security of supply and European gas prices.
Having said that, I mean, that is what's built in. Further growth beyond this, however, seems to be in doubt because Biden revoked the licenses for new LNG export terminals.
Yes.
I'm aware of because I have a little exposure to US gas and oil pipeline stocks. And so this will mean, I mean, you could well argue that a good energy combination would be renewables plus gas plants. But this is going to prevent much of the world getting the very cheap US gas that is available.
Yes, which is actually a great subsidy for US manufacturing.
True.
This is UK natural gas prices, sadly well off their lows. That's not good for UK inflation. US natural gas prices subdued, down 14% on the year. Coal going nowhere. Uranium, sadly for uranium bulls, the bull market has stagnated, going nowhere. Onto industrial metals, Stuart.
Well, a bit of a picture all over the place here. Aluminium has been strong, but cobalt rather weak. Neodymium is up almost 10%. So I'm not sure that there's any consistent story. You would think that China's slowdown, etc., would have led to something a bit more across the board, but I suppose it's already a well understood story.
Yeah, I think copper's very interesting, going nowhere.
Aluminium, well, yes, it spiked up the back end of July and into August, but that has now unwound. Cobalt, coming down in step changes. Copper, well, yes, there you are. There was a bit of a flurry, bit of a bounce, but that's since unwound and it's looking rather sickly. Iron ore, similarly sickly. It's been a longer story of weakness there, but absolutely no sign of any strength.
And that's exactly what you'd expect if the Chinese housing market is weak.
Lithium, trying to show a little bit of life, but basically still rather sickly. I think the issue here, we've seen some protests around the world, locals resisting the digging of lithium mines. So although lithium is available, getting the mine approval is going to be the big issue there.
Yeah, I think that's in Europe though, Stuart, Serbia and protesting against Rio Tinto's mine. But a lot of the lithium they've found huge deposits of lithium in the US and etc. The bottom line is we've looked for it, we've found loads of it, and the price has come down.
Right. Neodymium, so what's that used for? Because neodymium is showing a bit of sign of life here, isn't it? It's up from 450,000. I don't know what the unit is. Is that Canadian yuan per ton?
No, that's Chinese yuan.
Oh, sorry, Chinese, of course, yeah. But anyway, signs of life in neodymium.
Yeah, so that's used in magnets.
Right. Oh, so is that wind farms and things?
Yes.
Yeah.
But you've seen that the Chinese have put in export controls on rare earth metals. Is that what's causing this?
Right, makes sense. Nickel, trying to show signs of life earlier in the month, but that's all evaporated. Tin, again, weakness recently after some strength earlier in July and August. Zinc, same story. Moving on to precious metals. So gold has continued its very strong run. It's up 20% for the year, over 20% for the year, and up 1.2% since we last covered it. Is this why Richard is away? Is he spending his gains?
Yeah, he's having his boat gilded. He's got so much of
it. Right. Silver, similar numbers, up 17% for the year. The other metals not showing half the same amount of life. Platinum, rhodium up off for the week. Palladium up a bit, but still very painfully negative for the year. So here's the chart of gold. Been very nice over the past year, up 21% year to date. Gold price versus ETF flows, well, they used to be aligned, but the fact that gold has been rising despite the relative lack of interest by the ETF route suggests that it's other people buying, which presumably is central banks. Silver, despite the overall number, i.e. up 17% year to date, being the same as gold, the pattern is rather different, much stronger in the late spring, and there's actually been a bit weak over the summer. Platinum, or ugly chart, going nowhere, horrible. Rhodium, very flat for the past few months, really. Palladium, a bit more volatility to the number, but nothing interesting.
Yeah, I should say that we've gone through most of the charts this week because we haven't been we've been away for 3 weeks. Going forwards, we are not going to go through all the charts every week. We'll only aim is to cover just the ones where there's something interesting has happened, and to go through all the charts once a month. Okay, on to rates. This is the UK yield curve. Notice that the UK yield 30-year is at 4.55%. The good news is the yield curve is lower than it was a year ago, but inflation has come right down. I was fully expecting that to interest rates to fall much further, and you'll see the shape of the curve is much worse this year than it was last year. So last year you had a negative slope to the yield curve. This year it's actually got a positive slope. So you actually get a higher yield investing at 30-year than you do investing at 1 year. Amazing. And UK 30-year was at 4.55%. US is at 4.2%. So you now get a yield uplift of 35 basis points per annum by investing in the UK. And the FT had this chart, which shows UK yields relative to treasuries have risen by an astonishing 55 basis points since April. So hence, sterling is strong. You get much more yield investing in UK bonds versus US ones. And the vast flow of treasuries being sold to pay for the US budget deficit means that flow is overwhelming liquidity, leading to lots of dislocations in the US Treasury market. Now, if Kamala Harris gets in, she's got a plan for tackling the US budget deficit, which will involve US corporate tax rates going up from the current 21% to, I think, 27 or 28%. Bear that in mind. The US equities, have benefited from the huge US fiscal deficit. If the deficit starts to be cut, then corporate profits will also fall and the tax rate will rise. And US investors have been buying duration, but not very long duration. They've been buying the 2 to 10. Credit spreads on corporate bonds spiked massively during the yen carry trade, but they've since unwound. Markets are not concerned about corporate solvency. Good news is that the long-term Fed funds rate, the neutral rate estimate, has fallen sharply over the last few months. Fed starts cutting rates. Historically, that has been good for bonds. And US real yields have fallen sharply over the last 6 months. So the Fed is regaining credibility despite the US fiscal deficit and the amount of bond issuance being absolutely enormous. I thought this was interesting. We've had QT, and actually the balance sheets of the various central banks have fallen quite sharply over the last 3 years. This is the same chart for the UK. So you see that actually, so within the next year, the Bank of England's balance sheet as a percentage of GDP should be back to pre-COVID levels. This is the UK 2-year, not going anywhere. 10-year, that looks okay. 30-year, disappointing. It really hasn't moved down in the way the 2 and 10 years have moved down. So the UK has lost some inflation fighting credibility. They think that UK interest rates will be structurally higher over the next few years. This is the US 10-year and the German 10-year. Concluding comments. Well, equity markets have recovered very strongly from the volatility surrounding the unwinding of the yen carry trade, as we discussed last episode, but we are now entering September and October, traditionally the most volatile months of the year. And frankly, as we've discussed, valuations look very stretched, and the US economy has done very well, but there are indications that the labour markets continue to weaken. If that weakness continues, then the economy could slow. Inflation is fading. Oil prices are softening despite geopolitical tensions. Stuart, anything to discuss on your portfolio?
I've done remarkably little since last I was on, which was a few weeks ago. The only activity has been outside my SIP, where I bought a recent venture capital trust, which has just started to raise some money. That's the Mobius VCT. As ever, do your own homework. VCTs are risky, but that seemed like a quite good offering with a decent track record. And it's away from the AIM stocks that have not served me well in the VCT world. And you, Keith, how's it gone for you?
Thanks, Stuart. It's been shit. UK inflation came down better than expected. It's now at 2.2%, but long bonds sold off over the last few weeks, and I was down another 2.5% towards my lows for the year. Really terrible year, worst year ever. Not looking very clever, but bottom line is, we've talked about this throughout this episode. I can't bring myself to buy equities at these valuations. And so there's been a very long episode. We're not going to talk about it now, but Stuart has sent me a number of higher yielding funds. And actually, I'm going to look to buy yield in the expectation that lower inflation, I think, will allow the Bank of England to cut rates. Now, what we're seeing is that the new Labour government is going to raise taxes and cut government spending. That's going to bring down the deficit. That is bad for UK GDP and good for UK inflation, and fiscal prudence should be good for the bond market. Just as Liz Truss's fiscal imprudence was extremely bad for gilts, fiscal prudence should be good for gilts. So I'm expecting actually UK inflation to come under control, that will allow the Bank of England to cut rates more than the market is currently expecting. And I already have a large position in gilts. I am absolutely going to stick to my strategy, which is not to buy equities until, frankly, the blood is on the streets and everyone is panicking. That's historically the way I've made my money. I've still got another 30 years of this game, and I'm not going to start panicking because I've had a shit year. So next week, I will be going through some of the funds that Stuart has recommended to me, and the aim is to put some money to work buying yield. Talk about that next week when Stuart will again be with us. Reminder, that episode will be out next Tuesday, hopefully. In the meantime, thank you very much to Stuart Owen for filling in for Richard. Please can you press like and subscribe to the channel, and it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.